And welcome into Making Sense. You know, about a year ago when we started 2014, if you looked at the gasoline pump, it was probably about $3.70 a gallon. And we kept thinking maybe we're going to be hitting $4 a gallon. Kind of scary going into 2014. Different story in 2015 as we started the year, and gasoline is now under $2 a gallon. Should be good news, but it's not totally good news. And our guest is Brandt McDonald, Barranco, and Hagen Wealth Management.
Right.
And Brent, you know, everybody should be hallelujah, and everything should be coming up roses, and it's a few thorns with those roses.
Well, there's no question. I mean, you know, the dramatic drop in energy prices and gasoline prices, it clearly will have a major impact for consumers. I mean, this is sort of an indirect tax cut, if you will. So I think that as where the rubber meets the road in terms of consumer spending, what that does is it will increase discretionary spending. And let me tell you, it's going to come at a good time, because as we look at the wage situation and the employment picture, it's really not that great. When you sort of drill down, get up under the hood of these numbers, if you will, and look at the employment picture, one thing that Obamacare clearly did is it entirely recalibrated the workforce. You know, so let's use an example. You know, you take a Walmart, for example, where you had 3 full-time employees to do a job. Now you've got 5 part-time employees that are doing that job, because it forced employers to come under those 30 hours work weeks to avoid the penalties in the healthcare legislation. So you have a greater number of bodies on the payrolls, if you will, but total wage output is really about the same. And in fact, when you calibrate it in real terms, you have to go all the way back to 1999 to find a time where the average consumer had average hourly earnings equivalent to where we are today.
Amazing.
So we've seen real wages actually drop over the last 15 years. That's not good. So the consumer has absolutely been under a lot of pressure the last several years, and so with the drop in gasoline prices, that's going to absolutely help them. Let's look at the other side of this from a macro view, though, and why this is happening. There's absolutely no question in my mind that the rest of the world, if you look at the U.S. is accounting for roughly 1/3 of global GDP output, you can then look to the international markets where 2/3 of that global economy takes place, and that's where you have real problems, very systemic problems, infrastructure type problems from fiscal policy decisions that have been made overseas that are not doing well at all. So you can go and look at Japan, which is in very serious trouble, and they're doing everything they can by printing enormous amounts of yen through their own version of QE. And then China, which has somewhat of a broken credit market in their shadow banking system, and that's causing problems. And then also in Europe, where absolutely they're on a razor-thin margin, the southern European countries clearly in a recession, or in some cases a deep depression. So the rest of the world is in very bad shape, and that's causing the dollar to go through the roof. We've seen the dollar in the last many months just running like a scalded dog, if you will. And that's putting a lot of pressure on commodity prices, not to mention that the real demand that you would typically see in a real recovery is just not there. So raw materials like crude oil, natural gas, other types of metals and minerals and that type thing, the demand just hasn't been there because the global economy is not that strong. So we've seen commodities crashing down. Here in America, we've got this energy renaissance that's been underway, and there's been enormous amounts of money that's been invested in infrastructure for domestic drilling. I think, and one thing that we're greatly concerned about is what happens to the jobs in that industry as they begin to shutter, you know, sort of some of these rigs and slow down their production, which they're eventually going to have to do.
Right.
This is the shale oil stuff that's going on in America, and OPEC doesn't want to cut. You know, I mean, that for years they've sort of dominated the global supply of oil. Now we have the Americans that are a vital player in this, and the Saudis don't want to cut. They're looking at us saying, "No, you cut. You did this. You can cut." Neither one can really afford to cut. You look at Russia and Venezuela and Nicaragua, some of these other countries, they can't cut because their economy needs it so badly. So we've got this glut of supply, no real demand underneath all of this, and energy prices keep coming down. So on one hand, great for U.S. consumers. On the other hand, really, really bad in terms of the jobs picture for all of these people who've gone to work on U.S. Energy projects. And then, too, when you look at the credit markets, there's been a lot of money that's been borrowed to fund these infrastructure build-outs here in America. In some cases, when you look at those markets, we've seen some bonds trading as high as 25% yields. That's clearly a story where the credit markets are telling us we don't like this low oil. We're greatly concerned that some of these projects might not make it. So you want to sort of, there's a domestic consumer view, and then there's an international sort of macro view, the fallout from the other side. My personal opinion is that we're looking at a great deflationary situation globally, probably not going away anytime soon. But this is why it's so important, I think, for people who have money in markets to really understand clearly the interplay, all of these feedback loops that we have, counterparty risk as we do trade with our partners overseas in Europe, as well as in the Asian markets.
That's right. It's not a domestic thing. The other thing we were talking about is the fact that you're getting a little bit of relief at the gas pump, but that's probably just about offsetting the increase you're seeing in your healthcare costs.
Yes.
Most people's premiums.
Yeah.
If they've gone, I've had people say my premium went up $100 a month.
Right.
Well, if it went up $100, there's the gasoline thing right there.
Yeah, there's absolutely been not just healthcare costs that have gone up, but also real cost at the grocery store. You have this CPI number that's published at a national level, which incorporates all kinds of different inputs to determine the general level of pricing. But the reality is in most people who are watching the show, I'm sure this resonates well with them. You go in, you look at staple goods items that you buy in the grocery store every day. They've been going up.
Absolutely.
Okay.
On the upswing.
So that's been putting a squeeze on the average consumer, the middle class, the lower class, really having a very incredibly tough time absorbing these price increases. So I think with gasoline where it is right now, there's no question that's got to be providing some relief. Anyway, we'll see what happens. December retail sales this morning actually were down 0.9%, way worse than we expected.
Right.
We've got it. When I get back to the office, that's something we've got to look at. Yes.
Well, I appreciate. We're going to get you to come on back, and just remember, as Brandt was saying, these are very turbulent times. So be sure you take a look at your investments and make sure you're doing the right thing. We'll be right back right after this.